Welcome to Innovative Financing for Renewable Energy. My name is Gorica. I'm your instructor and I'm excited to be with you today. And let's go to the course outline. So, what we are going to study today: understanding innovative financing in renewable energy, green bonds, definition, trends, benefits, challenges, yield costs, structure, benefits, and one case study as well. Then we are going to move to crowdfunding for renewable energy, models and success stories. And we are going to finish with comparative analysis, choosing the right financial path. So let's move to the next slide. I'll start this session with innovative financing models, or continue with the innovative financing models that are actually reshaping how renewable energy projects secure funding. These models provide exciting alternatives to traditional debt and equity financing. So let's explore three key examples. First one, green bonds. Green bonds are actually financial instruments specifically earmarked for environmental or renewable energy projects. They function like traditional bonds but come with a sustainability focused purpose. Green bond issuance has been growing rapidly, driven by the global push for sustainability. For example, in 2022, the global green bond market exceeded 500 billion. What are the benefits? They offer a lower cost of capital and they attract sustainability focused investors such as pension funds and ESG, environmental, social, and governance investors. There are also some challenges, like transparency is critical. Issuers must ensure proper use of funds and demonstrate clear environmental benefits to maintain credibility. Second one is yield costs. Yield costs are publicly traded companies that own and operate renewable energy assets like solar farms or wind farms. They generate steady cash flow from the energy these assets produce. One example is Next Era Energy Partners, a prominent yieldco in the renewable energy sector. So, what are the benefits? Yieldcos appeal to long-term investors by offering steady returns through dividends. They also reduce risks by pooling multiple assets. From the other side, there are some challenges. However, they are not immune to market volatility or regulatory changes, which can impact investor confidence and stock performance. And third one is crowdfunding. So platforms like Kickstarter and Indiegogo are enabling renewable energy innovators to raise funds directly from the public. Um, there is a lot of success stories. For example, Solar Roadways, a project developing solar-powered roads, successfully raised funds through crowdfunding. Crowdfunding provides access to a large pool of investors and fosters community engagement, turning supporters into advocates. What are the challenges? High marketing costs and platform fees can eat into the funds raised, making it less efficient for larger scale projects. These models demonstrate the growing creativity in renewable energy financing. Each has unique benefits and challenges, making them suitable for different types of projects and investors. So this comparative table provides a clear overview of three prominent innovative financing models for renewable energy projects: green bonds, yield costs, and crowdfunding. So let's break it down to understand their unique features, advantages, and limitations. Green bonds, key features. Green bonds are specifically earmarked for environmental projects. They are increasingly popular option for renewable energy funding. Pros. They offer a lower cost of capital and attract ESG-focused investors who are keen on sustainable and responsible investing. Cons. However, there is a significant need for transparency to ensure that funds are being used properly, which can increase administrative oversight. Yield costs. Key features. Yield costs are publicly traded companies that own renewable energy assets such as wind farms or solar plants and generate consistent cash flows from their operations. They provide steady returns, making them attractive to long-term investors seeking predictable income streams. On the downside, yield costs are subject to market volatility and regulatory changes which can impact their performance and investor confidence. And at the end, crowdfunding. Crowdfunding platforms enable projects to raise small amounts of funding from a large number of people, often fostering community involvement and grassroots support. This model provides access to a large pool of investors and helps build community engagement around renewable energy projects. However, high marketing costs and platform fees can reduce the net funding received, making this option less cost effective for large scale projects. This table allows us to compare these models side by side, helping us identify which option may be best suited for different types of renewable energy initiatives. Each model brings its own set of strengths and challenges, and selecting the right one depends on the specific goals and context of your project. The graph that you can see on the right side of your screen showcases the remarkable growth in green bond issuance globally from 2014 to 2023. It is segmented by regions such as Africa, Asia Pacific, Europe, and so on and so on. And what, what are the key observations? First one, that there is exponential growth. Over the years, green bonds have transitioned from a niche financing tool to a mainstream option for funding renewable energy and sustainability projects. In 2014, for example, the issuance was minimal, but by 2023, the market has skyrocketed with annual issuance exceeding $400 billion globally. Um, if we are going to talk about regional contributions, Europe and North America have consistently led the way in issuing green bonds, reflecting strong regulatory support and investor demand for sustainable finance. Asia Pacific has also shown significant growth driven by renewable energy projects in countries like China and India. Emerging regions like Latin America and Africa, while smaller in volume, are gaining traction as they adopt green finance to fund their energy transitions. And what are the implications for renewable energy projects? Scalability. The increasing availability of green bonds enables large-scale renewable energy projects to secure funding at competitive rates. Um, Second one, investor appeal. Sustainability-focused investors, such as pension funds, and institutional investors are increasingly seeking green bonds to align their portfolios with ESG principles. Uh, this upward trend in green bond issuance signals a growing appetite for sustainable finance solutions. As more regions and industries adopt this model, we can expect even greater support for renewable energy innovations. Let's look at real-world example to understand the practical application of green bonds. Apple, a global technology leader, has been a trailblazer in using green bonds to fund its ambitious environmental goals. Since 2016, Apple has issued an impressive 4.7 billion in green bonds to support its commitment to becoming carbon neutral across its supply chain and products by 2030. This makes Apple one of the largest corporate issuers of green bonds globally. How the fund allocation went. The funds raised through Apple's green bonds have been strategically allocated to renewable energy projects, development and expansion of solar and wind farms to power operations with clean energy. Then energy efficiency improvements in upgrading facilities to reduce energy consumption and emissions. Then green technology innovation, investing in research and development of cutting edge sustainable technologies to further reduce their carbon footprint. Apple's case highlights the transformative potential of green bonds for advancing corporate sustainability goals by aligning their financial strategy with environmental objectives. Apple is not only reducing its environmental impact, but also setting a powerful example for other corporations. For more details and insights into Apple's approach, the complete case study is available as supplementary resource for this chapter. It offers deeper analysis, metrics, and strategies that you can apply to your own projects. Let's talk about yieldcos. Yieldcos are publicly traded companies, primarily own and operate renewable energy assets. These companies generate steady revenue through long-term contracts such as power purchase agreements, PPAs. A notable example is Next Era Energy Partners, which has successfully demonstrated the potential of yieldcos to provide stable financial returns. Yieldcos offer consistent dividends and long-term returns, making them appealing to investors seeking stable income. And the key characteristics of yieldcos are stable cash flows. Yieldcos generate reliable revenue streams from long-term contracts, as I said before, like PPAs, ensuring predictable earnings. Second, dividend payments. A significant portion of their earning is distributed as dividends, attracting income-focused investors who prefer regular payouts. Third, growth potential. Yieldcos can expand by acquiring additional operational renewable energy assets or developing new projects, contributing to their scalability. Fourth characteristic, lower risk. By owning mature and operational assets, yieldcos reduced investment risk compared to funding development stage projects. One more case study, Next Era Energy Partners, NEP. So Next Era Energy Partners is leading yieldco established by Next Era Energy, a global leader in wind and solar energy production. NEP specializes in owning and operating a diversified portfolio of renewable energy projects, including wind farms, solar installations, natural gas pipeline assets, and so on. The company focuses on leveraging long-term power purchase agreements to ensure stable and predictable cash flows. So let's talk about their financial strategy. One, dividend distribution. NEP consistently pays dividends to its shareholders, making it attractive to income-focused investors. Um, they're growing through acquisitions. NEP expands its portfolio by acquiring additional renewable energy assets, ensuring consistent revenue growth. Risk mitigation. By owning operational assets with established contracts, NEP minimizes financial risks compared to development stage projects. So, what are the key takeaways? NEP serves as a benchmark for other yield costs, aiming to balance financial returns with environmental sustainability. NEP's projects contribute significantly to the transition toward cleaner energy solutions by replacing fossil fuel-based energy generation with renewable sources. The company's strong financial performance and transparent reporting build investor trust, showcasing the viability of yield costs as a financial model. Um, Discussion points for the course. How do yield costs like NEP mitigate risks in volatile markets? Think about that. What role do long-term PPAs play in ensuring financial stability? Can the NEP model be replicated in other regions with different market conditions? And this case study will help to all students understand how innovative financing models like yield costs can drive the renewable energy industry forward. Crowdfunding has emerged as a powerful and inclusive way to finance renewable energy projects, enabling individuals to collectively contribute to the development of sustainable initiatives. By tapping into the power of communities, crowdfunding allows for both financial support and widespread engagement in green projects. So, what are the key benefits of crowdfunding? Broad accessibility. Crowdfunding opens opportunities for smaller investors who want to participate in renewable energy projects but may lack significant capital. Next one, community ownership. By involving a large number of backers, crowdfunding fosters a sense of ownership and responsibility for the project's success, often strengthening public support. Successful crowdfunding campaigns often generate publicity, raising awareness of the project and increasing its chances of success. So real-world example is, for example, solar roadways, one of the most recognized crowdfunding successes in renewable energy, a project aiming to transform roads into energy generating surfaces. The initiative raised over 2 million on platforms like Indiegogo, highlighting the public's appetite for innovative green solutions. The funding supported the development of prototypes and further research, showcasing how crowdfunding can drive early-stage innovation. Mm, There are also challenges in crowdfunding, like regulatory compliance. What that means? Project developers must navigate securities, regulations, and ensure transparency about fund usage to avoid legal issues. Next one is marketing costs. Successful campaigns require strategic marketing to reach potential backers, often necessitating upfront investments in outreach efforts. Third, platform fees. As we mentioned before, crowdfunding platforms charge fees for hosting campaigns, reducing the final funds received by project developers. But despite of these challenges, crowdfunding has proven to be an effective tool for renewable energy projects, especially in the early stages of development. It provides unique avenue to raise capital while building a network of engaging stakeholders who are invested in the project's success. Crowdfunding offers various models to suit different needs, each with unique structures and benefits. For renewable energy initiatives, selecting the right type of crowdfunding can help align financial goals with community engagement. So let's go through different types of crowdfunding. First one, donation-based crowdfunding. This model involves contributions from individuals who do not expect any financial returns. It is particularly popular among non-profits and community projects aiming to promote clean energy or sustainability. An example, a community solar project seeking to install solar panels in low-income neighborhoods can use donation-based crowdfunding to gather support from eco-conscious donors. Advantages: builds goodwill and community involvement without the pressure of financial obligations. Platform examples: GoFundMe, Crowdfunder, and so on. Next one is reward-based crowdfunding. So backers receive tangible items, services, or recognition in exchange for their financial support. This model is common for creative or innovative green energy products. Example: a startup developing solar-powered charging stations could offer early access to the product or branded merchandise as rewards to backers. Advantages: incentivizes participation while promoting the product to early adopters. Platform examples: Kickstarter and Indiegogo. Third one, equity crowdfunding. So contributors invest in the project or company in exchange for equity, making them partial owners. This model is suitable for renewable energy companies looking for growth capital. A renewable energy startup seeking to commercialize a new wind turbine technology might offer shares to investors via equity crowdfunding. Advantages: provide significant funding while involving investors in long-term success. Platform examples: Seeders, Crowdcube, and so on. Fourth one, debt crowdfunding, peer-to-peer lending. Investors lend money to a project or company with the expectation of repayment, usually with interest. This model suits companies with clear revenue streams, such as operational solar farms. Example: a company needing financing to expand its wind farm could secure loans from multiple lenders on a peer-to-peer platform. Advantages: access to quick funding without diluting ownership. And platform examples: a lending club, funding circle, and so on. So, choosing the right crowdfunding model for renewable energy projects. The choice of crowdfunding type depends on the project stage, goals, and target audience. Donation-based and reward-based models are ideal for community-driven or nearly-stage initiatives, while equity and debt crowdfunding cater to more established companies seeking sustainable funding for expansion. And let's go to our solar roadways case study. A project that represents an exciting case study in innovative crowdfunding for renewable energy infrastructure. Below is a breakdown of the project goals, the crowdfunding approach, and its impact. So, Solar Roadways proposes transforming traditional asphalt and concrete surfaces into solar power generators by embedding photovoltaic cells into durable textured glass. These roads not only generate electricity but also enhance safety and utility. So, what are the key features? LED lights for customizable road markings, heating elements to melt snow and ice in winter conditions, built in safety and monitoring systems, and potential benefits: renewable electricity generation at scale, reduction in fossil fuel dependency, improved road safety and maintenance. What is the crowdfunding strategy behind these projects? Solar Roadways utilize the reward-based crowdfunding to secure initial funding for research and development. They were using platform Indiegogo. Uh, they raised over 2 million from individuals around the globe. And let's talk about campaign tactics a little bit. So, engaging storytelling, highlighting the vision of smarter, greener infrastructure, visual and video demonstrations of prototypes, transparent communication about project milestones and progress. Challenges and solutions. One, technical feasibility. Developing durable, cost-effective materials to replace traditional road surfaces. What was the solution? Partnering with material scientists and engineers to test and refine prototypes. What was the public perception? Overcoming skepticism about cost and practicality. Solution: sharing detailed technical insights and small-scale pilot projects results. Third, scalability, transitioning actually from prototypes to widespread implementation. What was the solution? Securing partnership with municipal governments and investors. Let's talk about impact and future prospects. While the technology is still evolving, Solar Roadways has ignited interest in integrating renewable energy with existing infrastructure. Pilot installations and ongoing R&D suggest the potential for widespread adoption in the future. When evaluating financing models for renewable energy projects, it's essential actually to consider several critical factors, including cost, accessibility, risk, and returns. Each financing option presents unique opportunities and challenges, making it suitable for different project scales, investors, profiles, and goals. So, traditional financing methods such as loans or equity investment uh, through conventional banking channels remain a go-to for many projects. As far as cost is concerned, moderate interest rates make this option viable, but not always the cheapest. As far as accessibility is concerned, banks and other financial institutions are well established and generally have high availability globally. What are the risks? Borrowers assume a higher risk as loans often require collateral and repayment are fixed, regardless of project performance. Returns to investors or lenders are predictable but can be lower compared to more innovative financing models. Green bonds. Green bonds have emerged as a sustainable financing option, attracting ESG investors. They generally offer lower interest rates due to their sustainable focus. Green bonds are increasingly available as financial institutions and governments push for renewable energy growth. They have low risk for both investors and issuers, and these bonds are often backed by reliable projects. Returns are moderate to high, with predictable interest payments ensuring stability. Yield costs. They are actually ideal for long-term investors seeking steady cash flow from operating renewable energy assets. The initial cost is moderate due to the need for public market listing and operational readiness. Access is moderate since yield costs are primarily traded publicly and require institutional backing for creation. Yield costs pose moderate risk due to market volatility, but are backed by operational assets reducing exposure. As far as returns are concerned, moderate to high returns through dividends and equity growth are attractive to investors. Let's go to crowdfunding. Crowdfunding has become an innovative and flexible way to finance renewable energy projects. As far as cost is concerned, it is variable depending on platform fees and marketing efforts. It is highly accessible to projects with strong community and grassroots appeal. Risk is high as success depends on public interest and regulatory compliance. Returns can be variable, ranging from donations, no returns, to equity stakes or fixed interest in debt-based crowdfunding. So what are the key takeaways? As far as cost efficiency is concerned, green bonds stand out as the most cost-efficient option for renewable energy projects. Traditional financing and crowdfunding offer the highest accessibility due to their widespread use and adaptability. Risk management. Green bonds and yield costs provide lower risk, appealing to risk-averse investors. High returns potential. Yield costs and green bonds deliver consistent, moderate to high returns, while crowdfunding offers variable outcomes, making it riskier but more flexible. This comparative analysis underscores that selecting the right financing model depends on the project financial needs, risk tolerance, and stakeholder expectations. By blending traditional and innovative options, renewable energy developers can align their funding strategy with long-term sustainability goals. At the end of this free course, you understand the structure and function of green bonds, yield costs, and crowdfunding. You know how to analyze real-world examples of innovative financing in action, evaluate pros and cons of different financing models. You gain strategic insights into funding your renewable energy projects. And thank you so much for participating.